Hey everyone, hope you're all doing well. If you haven't already, please consider subscribing. It'll really help out the channel and motivate me to make some more videos. So we're now in video 4 of the How to Value Stock series. And today we're going to be looking at the balance sheet, and we're back on Yahoo Finance. Amazon's been our example company throughout the series, so we're just going to stick with that. And let's work our way over to the financials and take a look at the balance sheet. All right. So now that we're at the balance sheet, as always, we want to note the order of accounts. Up top, we have assets, then liabilities, and then shareholders' equity or just equity. And another thing to note when you're looking at the balance sheet is that balance sheet accounts are permanent. And what I mean by this is that the assets for 2019 is not just the assets that Amazon acquired in 2019. These are all the assets the company has, period. So everything on the balance sheet is a total from all the transactions the company has ever had. So it's cumulative in that sense. So for example, in 2018, it looks like they had 162 billion or so assets. And then the difference between these two is what they added in this year. So they added about, what would that be? 60 or so billion in assets. So we just add 60 billion to the previous total. This is not just for this year, if that makes sense. Like the income statement, we were looking at net income from just that year. This is the cumulative amount of assets and the cumulative amount of all the accounts on the balance sheet. So I hope that makes sense. So I'm going to start at the top and work my way down as we always do and explain each account as we go. So let's just start. So assets are resources or things of value that a company owns. So what might a company own that's of value? Well, they're probably going to have cash, which we can find in current assets. And they might own an office building, which would be under total non-current assets. And if we open up net PP&E, we'll find it over here, and we can see land and machinery and other properties. And yeah, these are all of our assets. These all have value to the company. So assets are pretty simple, right? That's all there is to it. Anything that the company owns that is of value, that's an asset. So assets are then broken down into two categories as I kind of open them up. So we have current assets and non-current assets, or otherwise called long-term assets. So current assets are a company's cash and its other assets that are expected to be converted to cash within 1 year. So everything, let me close this one out, everything up here under current assets, this is all likely to be converted to cash in 1 year if it's not already in this cash account. So cash is pretty self-explanatory. This is just the cash the company has on hand and any other short-term investments maybe it has that it's planning on selling within the next year. So now receivables, we have accounts receivables, and this is the amount owed to the company on credit sales. So let's use an example. Let's think about a manufacturer that makes products and sells in bulk to Walmart, and they give Walmart 30 days to pay back that amount. That amount would be accounts receivable until they get paid, right? So they're owed that amount. The company is owed for the products it gave to Walmart. So then they can count it as an asset because they're going to receive it. They're going to receive that income in the future. And accounts receivable is composed of two parts. So the gross, which is just means the total amount of credit sales, and then the allowance for doubtful accounts. And what the allowance for doubtful accounts is, this is management's best estimate of the amount of accounts receivables that will not be paid back by customers. When you sell on credit, there's always the risk that you'll never get paid back, and this is why banks charge interest and credit card companies charge interest, because there's a risk that they won't be paid back. And this is the same for companies. So management has to kind of budget for this and estimate how much they won't get back and take that out of the gross amount. And then that's what leaves us with this net amount up here with just the accounts receivable account. So our next account is inventory, and this is just the merchandise or products that are going to be sold to customers. These are the products the company has on hand that are ready to be sold to customers. So if we're using Amazon as our example, all those Alexas sitting in the Amazon warehouse are inventory. Then as soon as you buy one, that Alexa is moved out of inventory and becomes cost of goods sold. So yeah, inventory, you guys are probably familiar with it. Not too complex here. It's just the products the company has on hand that are ready to be sold to customers. So that's going to be all for our current assets. And let's open up non-current assets. So the first thing we have here is net PPE. And all PPE stands for is property, plant, and equipment. And if we open that up and open up gross, remember gross is just our total. So this is our total PP&E. And we have property, land, machinery, other properties, and then construction in progress, which would just be any buildings or warehouses or anything that's currently in the process of being built. And then once it's completed, it'll be moved into one of these other accounts. So yeah, that's all there is there. Not much to really look into here. Kind of just gives you an understanding of how their assets are comprised. Like we have machinery seems to be making up the biggest amount, then land over here, and other properties. And this isn't going to be too important, but you know where it is, and if you ever need to use it in a calculation or anything, you know where to find it. So the reason that this is gross PPE and not just PPE is because we have to account for depreciation. And I kind of talked about depreciation last time, but as a quick recap, depreciation shows the loss in value of assets over time as they become less useful, functional, or obsolete. And accumulated depreciation is just all that depreciation expense we talked about last time. It's the depreciation expense on all the assets we hold, and then you add that all together because it's on the balance sheet, so it's cumulative. So if we take this 144, subtract it from that 46, we just get our net PP&E, which is why it's net up here, because it's less that accumulated depreciation. And that's all there really is to know there. And let's look at intangible. So goodwill and other intangible assets. Intangible assets are just non-physical assets. So things you can't touch, like the value of trademarks or copyrights or patents. And it's not going to list them all out here, but that's what the other intangible assets is talking about. And then goodwill is a type of an intangible asset associated with a merger acquisition. So an example would probably explain this best. Amazon acquired Whole Foods a few years back for $13.4 billion. And I'm just going to make up the rest of the numbers as we go in this example, but the point will be taken. So let's say Whole Foods had $1.6 billion in debt when Amazon acquired them. Since Amazon is acquiring Whole Foods, that debt becomes Amazon's. So actually what they paid was that $13.4 billion in cash or stock or whatever they paid, plus the $1.6 billion in debt that they're going to bring in. So the total purchase price will be $15 billion. But let's say Whole Foods only had assets worth $10 billion. Now Amazon paid $15 billion for only $10 billion of assets. And why would they do that? And this is where goodwill comes into play. It represents the non-physical assets acquired, such as the value created by a solid customer base, the brand recognition that Whole Foods has, any managers or excellent management that they brought in, and synergy benefits. So it kind of takes into all those other things that may not just be reflected on Whole Foods' balance sheet. So long story short, goodwill is just the residual value. So what's left of the company, of how much the company paid for the company they're acquiring, less the assets on that company's balance sheet, if that makes sense. I hope the example helped. Goodwill, if you are having trouble understanding it, maybe look it up on Investopedia and kind of just make sure you get a grasp of that one, because you're going to see that on a lot of these big companies' balance sheets. All right, so I think that's going to be all for our assets, and we can close those out. And now we're going to move over to liabilities. So liabilities are what the company owes to creditors. So if the company borrows 10 million from the bank, that's a liability. They have to pay back that 10 million plus interest. And just like you or me, if we take out a loan, that's a liability on us. And it's the same for companies. That something you need to pay back, that's a liability. So current liability is an obligation that will be due within 1 year. And like our current assets, so for current assets, it was an asset that's likely to be converted to cash in 1 year. Current liabilities are liabilities that are going to be paid in 1 year. So we kind of see that 1 year is that threshold for current. So if we open up current liabilities, let's take a look at what's in here, and we have payables. And we can open up those further, and it comes down to account payable. So account payables are the amount due to vendors or suppliers for goods or services that have not yet been paid for. So if Amazon, let's say, buys supplies from a manufacturer, they need supplies for something, but they pay for it on credit, then that becomes accounts payable because they still have to pay that supplier for the product that they bought on credit. So it's kind of just the reverse of accounts receivable here. If now you're buying something on credit, then it becomes a liability for you because even though you haven't paid it in cash yet, you got to pay it back at some point. So that's a liability. And yeah, those are our payables. Now let's get to accrued expenses. So accrued expenses are expenses that have occurred but not yet been paid for. And the best example for this is going to be interest. So let's say you have a loan that you got at the beginning of the year and it's worth $1 million. And the bank that you got it from charges 3% interest per year. The loan matures in 1 year and the full principal and interest are only paid when the loan matures. So imagine you're 3 months into that year and you release your quarterly financial statements. We haven't paid any interest on the loan yet, right? It's due only at the end of the term of the loan, which is in 1 year. But we've held it for 3 months and are we've technically built up 3 months worth of interest, even though it hasn't been paid yet. So it should still represent a liability. And so if we're looking at that 3% loan on the 1 million, that would bring us to what? That would bring us to 30,000 if my math is right. So we technically need to charge that 30,000 as an accrued interest expense because it's got to be paid in the future. So it's a liability for us. And even though we don't have to pay it for another year, we're looking at it from a time perspective. We've used it for those 3 months. And that's really the basis of accounting. We have to consider the use and not necessarily when the cash is moving hands. So that's going to be why we're going to have these accrued expenses. It's things that have not yet been paid for but have been used. So just think about our interest example. It's a little confusing. Even when you're valuing stocks, this isn't stuff that you're going to need to understand in really great detail, but just having a basic understanding is good. And hopefully you'll have that by the end of this video and throughout our tutorials. And don't worry about it now if you're not getting it. We'll probably come back to it. And if we don't, always do your research on your own time and pick up on it. So let's look at deferred revenue next, or deferred liabilities. And we have our deferred revenue. So this one's a little simpler than accrued expenses. So this is just any prepayments a company receives before actually performing the service or delivering the product. So an example is pretty easy here. If you pre-order a game a month in advance, the company gets all your cash, right? Let's say they charge you the full price when you pre-order it. Now the company has your cash, but they haven't given you the game yet. So it becomes a liability for them until they give you that game. And until you're given what you're owed, only then can they remove that liability and recognize the revenue. So that one's pretty simple. It's just any prepayments the company may get before delivering the product or service. And those are going to be our current liabilities. and now our total non-current liabilities or long-term liabilities. So first we have long-term debt, which is broken into two parts here. The first part would just be basic long-term debt, like any loans the company has or bonds the company has outstanding that are longer than 1 year now that we're looking at non-current. And capital lease obligations are from the liability created when a company signs a lease for office buildings or equipment. So pretty easy here. Just what the company owes from leases or bonds or really any outstanding debt they have. And that's going to be all for our long-term liabilities. So now we're finally down at equity. So equity refers to the owner's residual claim on assets after debts have been paid. So this would be the amount that a company's shareholders would receive if all assets were liquidated and all of the company's debt was paid off. And residual just means what's left over. So that brings us back to one of the fundamental equations of accounting, which is assets equals liabilities plus shareholders' equity, and whichever way you want to turn that. So equity equals assets minus liabilities. So we have 225 minus 163. If you work out the math, it'll give you the 62 billion right here. So yeah, that's an important equation to know. Definitely know that, because when we're valuing companies, it's probably going to come up where we need to balance the accounting equation, and that's what people refer to as that assets always has to equal liabilities plus equity. And we'll get into that later, but pretty simple equation. It's just one thing equals these two other things added together. So now when we open up equity, shareholders' equity, we have capital stock, which just refers to any shares issued by Amazon in this case. And then we also have additional paid-in capital, which is the amount investors pay above par value for a company's shares. So par value is just a stated value in the company's charter, but it's not really an important amount. The share price when the company IPOs is what really matters. And additional paid-in capital is just that amount, the amount of the share price when the company IPOs and sells its shares to the public, less that par value in the charter. That could be really anything that they wanted to put. So yeah, really all that matters in there is just what they're going to get when they issue shares, because that becomes cash that they can use to finance their business. And yeah, that's pretty much all there is to additional paid-in capital. And next we have retained earnings, which is probably the most important account in equity. And this is the amount of net income left over after the company has paid out dividends to its shareholders. So Amazon doesn't pay out dividends, so we don't have to worry about that here. But we have to remember that everything on the balance sheet is permanent. So it's not just this year's net income. Retained earnings is the cumulative net income from all the years. So if we wanted to find net income or retained earnings, we have our retained earnings from last year in 2018, which is about 19 billion. And then to get this year's, we would have to add in whatever this year's net income was from the net income statement, and then that'd give us to this amount. And if we had any dividends, we would have to subtract those out, but Amazon doesn't, so we don't have to worry about that in this case. But it's always going to give you these numbers, but it's nice to know the calculations behind them. So retained earnings is just last year's retained earnings plus this year's net income minus any dividends paid out this year. And that'll give you this retained earnings total. And treasury stock, this is going to be the shares that a company's repurchased and bought back from shareholders. It's also called reacquired stock. And so it's just a company buying back their shares on the open market. And this is going to decrease the amount of shares on the open market since they're buying them back and holding them. And since there's less shares outstanding, we might see an increase in the company's earnings per share, right? Because earnings per share is the net income divided by the total number of shares outstanding. And if the company buys back shares, that's going to lower the denominator, which is going to increase the earnings per share. So that's why companies you've probably heard of share buybacks, which is just a company buying back their shares, which then ends up in this treasury stock account. So treasury stock just shows the amount that the company has bought back of their own shares. Right? If there's less shares on the open market, it also increases the value of your share. Now that there's less of them, the share that you have is more valuable than it was before, since the quantity available has gone down. And then that's going to be all for equity. And we're almost through with the balance sheet. Some important things to note down here. Let's take a look. We have net tangible assets, which is the value of all physical assets, right? We talked about tangible, or we talked about intangible. Tangible is going to be what's physical, since intangible is what's non-physical, or what you can't touch. So net tangible assets is the value of all physical assets minus all liabilities. Or another way to find this would be the total assets minus any intangible assets less those liabilities. So there's kind of two ways to find it, but just know it's the physical assets minus any liabilities that the company has. And the reason that investors may want to know this information is physical assets. It's a lot easier to sell something that's physical to you than this intangible thing that I'm assigning value to. Let's say it's a trademark or a trademark, and you have to figure out the value of what that's worth. And it's like, well, I don't really know what I'm receiving other than a piece of paper that says it's worth this much, versus if you're buying a car from me, you're actually getting a physical car versus just a document that says, well, now you own this trade name. So it's a little more liquid, and that's why investors may want to know, okay, what's the amount left over? Since it's easier to sell these physical assets, how much would we have if we had to sell all of them? Would we be able to pay off our liabilities? And how much would we have left over after that? So if that's confusing, I'm sorry. Let me go over it one more time. So it's the company's physical assets less all their liabilities. And this will tell you how much the company has left over if it had to sell all of its physical assets and then pay off all of its liabilities. What would be left for the owners after that? And that's what this amount is. And then our next one is working capital, also known as net working capital. And this is going to be the difference between the company's current assets, such as the cash, accounts receivable, and inventory that we talked about, less its current liabilities, such as accounts payable and the other ones we looked at. And this is a measure of a company's liquidity, right? If a company had to pay off all of its current liabilities right now, it'd be most easy to sell those current assets, right? Since these are the ones we're likely to convert to cash in the next year. So if we had to pay off all of our liabilities in the next year, would we have enough given our current assets? And Amazon has excess in this case, so they would be able to pay off all those current liabilities that they have, and then some. So this would tell you if a company's like cash pressed and they're facing bankruptcy, if the current liabilities are higher than the current assets, it's not good news for them, because within the next year, those assets that are going to be converted to cash aren't going to be enough to cover those liabilities that need to be paid in that year. So this kind of gives you a good short-term indication of the company's balance sheet. And that's going to be all for the balance sheet. And I'm going to jump over and give you guys a quick summary. So give me a second here. So now here's just a quick summary. I did this last time for the income statement, kind of just a screenshot review, because there's a lot I talked about and kind of a lot you need to process. So looking over this might help you kind of retain the information and remember it. And it's kind of just going through all the major accounts we talked about. So if you kind of understand this and can give a little 1 sentence to 2 sentence summary of what each of these accounts are, you're in good shape, and you're almost ready to be valuing stocks. So all we have is one more financial statement left, and then we can put all this stuff in the past and start doing calculations and figuring out the value of companies. But it's really important that you understand these financial statements first. So we just knocked out the balance sheet. Last video, we took out the income statement, and all we have left is the cash flow statement. And I'll get that out to you guys soon. Like the video and let me know if you're supportive of this video and it gets a lot of engagement, then I'll be able to drop the next one more quickly. But until next time, hope you guys enjoy. Leave any comments if there's anything else you guys want to see. I know there's been a lot going on with the election and the stock market going up a lot. We saw it go down and now it's up. If you guys want some of these if you want some answers to these questions, let me know, and I'll see you guys next time. Thanks.